Welcome to the DeFinity Market Strategy. I'm Paul Rodriguez of ThinkTrading.com, joined with Manu Choudhary, who's the co-founder of DeFinity and the CEO of DMA Link. Welcome, Manu. What are you looking at in the markets this week?
Hey Paul, how you doing?
I'm very good, thanks.
So listen, very, very interesting things have been happening the last week or so. And I guess, again, just going back to the comments I made last week about Gary Gensler, I want to cover that off in a bit more detail. The rhetoric we saw from Gary, essentially he was very anti a Bitcoin ETF. Interestingly, he had a bit of a spat with the chairman of the CFTC. And essentially, he seems to have taken a slightly different direction to this. So now he is averse to a traditional ETF, but he's not averse to a CME futures-based ETF. And fundamentally, the difference between this is, for instance, if you look at, say, Wisdom Tree Gold ETF, they own physical gold that is held in custody on their behalf. If you look at, say, the BlackRock Brent trust, that basically doesn't own any physical oil. It basically just holds the futures. So why would Gary be keen for a futures-based ETF but not a traditional Bitcoin/Ethereum-based ETF? And I think the reason is quite simple. That one of the big pushes that Gary's been really driving with the regulatory acts that he has to grind with the government is he wants more oversight from a crypto custody perspective. Now, if you look at an article that came out last week from the Block Crypto, they essentially highlighted that 55% of the top 100 banks are essentially investing very heavily into the crypto/blockchain space. Of those, 25% are investing specifically in crypto custody. So is the real reason that Gary's keen to drag his heels with more traditional asset-based ETFs more to do with the fact that he wants the regulatory framework changed such that only banks, for instance, can custody digital assets? That might be the reason. And if that's the case, then this is probably 12, maybe 18 months away from actually launching a proper ETF. The ETF based on the CME futures, as far as I'm aware, they have probably about 30 to 40 days to consider the applications. And I think since he made the statement last week, there's been about a dozen firms that have applied to run CME futures-based ETFs in Bitcoin and, interestingly, Ethereum. So the Ethereum future was launched earlier this year. So I think this is again, a really interesting juxtaposition that we're seeing between what Gary is saying and what seems to be happening. But there seems to be a little bit of a land grab between the CFTC and also the SEC, which is interesting that the regulators seem to be not necessarily be fighting amongst each other, but they're showing some very interesting signs, shall we say, to the market.
Is that potentially long-term positive? Because it means they're taking things far more seriously than one might have thought before.
I think it is. I think what's happened is that a lot of the major banks have worked out that Bitcoin and Ethereum are really no real risk to their business. They're actually something they should engage with, and they're probably looking to try and put a stop to the billions and billions of dollars leaving their balance sheets, going to exchanges by finding a solution themselves, either building it or buying it. So I think long term it's going to be very supportive for the price. I think short term, again, as I kind of mentioned last time, my only concern is if we do see the launch of an essentially a futures-based ETF, is it going to be a similar scenario to what we saw in December 2017, i.e. it would mark an interim top with a major correction? I think it might do.
So, yeah, very interesting. Any other thoughts on the markets, or should we go to the technicals?
I think that, look, the only other thoughts I have in the market are that whilst we've seen, again, a decent move higher, what concerns me, again, as it did last week, is that we've seen quite a lot of bearish divergence. The volume just doesn't support the trend higher. So, again, which ties into the narrative that we've seen ourselves, which is that whilst this looks like it is a decent move, it looks like it is just part of a correction.
Yeah, I mean that's very interesting, Manu. I mean, what we've got going on here is this week. I think we've really got to be looking at the whole risk-off proposition of the markets. Now, I mentioned the Far East and the Far East stock markets in various of the weekly documents that we put out for a very good reason, because look, this is the chart of the Taiwanese stock market, which was blasting high. It was like an amazing upward trend. Chip shortages and all sorts of stuff going on, and this was sending this higher throughout the year. April, we got a correction. Sure, you'd expect a bit of a correction. That's fine. Then it went into new highs again, but that high has failed and it's not extended. Small double top, head and shoulders reversal. It's now coming down. It's broken its main trend line, and it's heading potentially for this major support level here, which is at 15,089, just shy of the 15,000 level. So what is going on? Will this turn around and go back up and it all just be bullish? Or is this going to collapse and go further? Well, that's a really good question. And the main driver for the Taiwanese market could well be the rest of the region. So if we look at the Hong Kong market, again, this was featured in the weekly. It's already collapsed another 500 points overnight. It's just down 400 as we speak. And it's looking very bearish. You can see it's even broken this previous low that we put in the weekly, saying that it was a very important level. So that is looking quite weak. And the Chinese stock market is also looking very weak, very similarly heading towards its previous support. Now, these markets have been operating on their own in the sense that the Asian region has been slightly fragmented. Hong Kong, China has been going lower, but some markets have been going higher, and there seems to be a bit of a risk on. But if we now look at the main drivers of the upward trend, which is the US markets, you can see this has not really been interrupted. The S&P 500 still going upwards. It doesn't look like there's much going on here. But if we break down the move in the Dow Jones, we can see it went into a new high. That really should have extended, and it's come straight back down again. I don't like the way it's done that. I think this should have at least consolidated over that high and then push upwards. Now, that's still possible, but there's a few more pieces of the puzzle suggesting that risk off is going to be the dominant feature going into September and potentially longer. One of the main risk assets or one main drivers of risk is whether you can borrow money cheaply and what currency you can do that in. Now, again, we talked about strength of the US dollar. Strength in the dollar affects just about every other asset. Why would you buy gold if you can buy dollars? If interest rates are going to start to go up, then the market won't wait for those rates to go up. They'll start buying well ahead. This could potentially be a forward-looking play into perhaps a nudge up in interest rates. Now, that might come from inflation. It might come from another source. That's probably a bit beyond this morning's program. But the dollar is definitely pushing upwards, and it may consolidate a bit here because we got such a big level. But if this starts to edge even higher, I think it's going to put more pressure on the equity markets. Now, we saw a fantastic move in the European stock markets, which is quite an unusual thing because they've been lagging. And so looking at the European equities, the French stock market, the German stock market, the Swiss stock market were actually all blasting higher and looked really good technically. Then the market turned round and has had a bit of a correction. Now, it's still within the upward trend, but the rate of this correction is slightly of concern. Look at the size of this gap. Now, a gap is when the market closes and it reopens with extended selling pressure. That is a big gap, and the market is still weak. So I'm getting a bit more concerned that we're going to see a correction in the very strong US markets as well, and this might turn into something quite a lot bigger. Now, one of the main things that can indicate that is the VIX Index. So usually the big players start to buy this when they think the market's going to go down. Now, this trend has basically been to the downside. So we've seen a trend to the downside for some time now. And every single rally, the market goes a bit lower. And so therefore, whenever it spikes up, the market usually is a little bit relaxed about it. It's only if it stays up here that the market starts to think that this could extend into something a bit more aggressive. Now, the key level here, the big resistance level, is at 25.16. If it hangs around here for this next few days and then breaks through, I think we're going to see quite a big correction going on in the rest of the market. So there's a lot to see in terms of the equities and the dollar. So if you're on holiday, I'd certainly be keeping an update on where the markets are going, because it could get pretty aggressive. Now, you mentioned Bitcoin, and I think what you're saying is absolutely right. We've got a correction to the downside here. The market's moving back upwards, and it's hit some resistance. It hit the 46,000 level, just over that as resistance. That's a fib level. And it's consolidating. It's coming back for another move. Actually, it may well even break this again and go up to around 51,000. But that's still within the context of this correction. And I think if it can get below 42,500, then we'll probably just see this range trade for the rest of the year, maybe even break lower. And then we'll see a massive rally in 2022. Now, there is a chance that this could go straight up. We've got to look at all the alternatives, the potential for this just to turn into a massive rally. And that is possible. Anything's possible in the markets. But at the moment, that's not the favored strategy, simply because this is still a corrective phase. Now, it's showing some very good consolidation around these highs. So it's not like hitting it, coming straight off and then going down. So that shows that the market doesn't actually want to sell immediately upon hitting these levels, which is why we got to consider that there'll be perhaps one more push that will spike it up and then it will reverse back down. But it would be very difficult for this market and broadly risk-on trades to operate if the rest of the market is going down. And there's a phrase that we use in the markets: the only thing that goes up during a broad market collapse is volatility. And that could be the scenario that we're moving to into September, October, actually even August have been known to be crash months. So we can never rule out the prospects for a crash in these months, and they really can come very quickly. So I would be looking out for any further signals that the market's going to go down quite fast. This all could go to nothing, and that's possible, but it's better to be forewarned than forearmed. And one of the other major stock markets that I think is very well worth looking at is the Russell 2000. Now, the symmetry on this is amazing. We've got what I consider to be a left shoulder, which lasted 24 bars. We've got the head, which is this area in the between, and we projected a move down on the 20th of August. So that's today. So we could see a break of this support level at 2106 today. And if that happens, this will have completed a major top and it will put into place a correction in most of the other markets. So although it's probably not the most actively traded market, it's definitely one to keep an eye on for the health of the rest of the stock market and potentially for the risk-on scenarios. So that's a roundup of the charts and the technical analysis. Manu, any further thoughts before we end the show?
No, I think just as you kind of alluded to before, just keep your eyes open for some of these quite major turning points. And I think when we do see this move, it's going to happen very quickly. So be prepared to take advantage of it.
I think another point to make is that some of the other coins are doing extremely well. They're actually not following what Bitcoin's doing. So this is not a one market is representative of the whole of the crypto space. There are some coins that are doing much better. There are some that are doing worse. So if you'd like us to look at one of those markets, just drop a note in the comments and we will look at it for you next week. So thank you so much for listening, guys. Don't forget to like and subscribe, and we will catch you next time.